Welcome to Taking Stock for the week ending 4th of August, 2023. I'm Tim Lincoln, and joining me today is Kien Trinh, our head of Stock Doctor Research, to stream you all things share market. Welcome, Kien. How are you?
Well, very well, Tim. Reporting season's on our doorstep right now, and things are going to heat up pretty quickly.
Yeah, absolutely. There's no rest around Lincoln indicators at the moment. Things are certainly heating up. But before we get started, Kien, a quick and important reminder for our members and guests today. The information we provide during this episode of Taking Stock is of a general nature and should not be taken as personal advice. And remember, shares are a volatile asset class, and any charts, tables, and performance figures we share today should not be relied upon as a guide for future performance. Well, a massive week in equity markets, Kien. Lots of volatility, both here and in the US. And please share with our members and guests, Kien, what's been driving that volatility.
Yeah, very interesting week in markets, Tim, especially after months of consecutive gains. But the volatility appears to be motivated by the downgrade of the US credit rating by Fitch, but really, that's not the case, Tim. The sell down was actually driven by a rise in bond yields. And if you can recall, remember, bond yields reflect interest rate expectations, and bond yields rose after the US jobs survey showed a stronger than expected employment market there. In addition, you had the US Treasury Department deciding to increase the amount of long-term debt it wants to sell, and this also drove yields higher as well. So what does this all mean? Interest rates could stay higher for longer, Tim, increasing the possibility of a recession further down the track. Meanwhile, only this week, the RBA has kept the cash rate on hold for a second month at 4.1% because it really needs time to reassess the effects of the rate hikes it delivered in financial year 23. And the futures market, now they are anticipating that there is only a 24% chance that the RBA could raise rates next month. However, interest rates could remain quite elevated for some time, Tim, and this could bite into the financial health of companies.
Yeah, it's a very interesting period, isn't it? It's I haven't seen anything quite like this before. So many moving parts that we just need to be so diligent around keeping an eye on. And as mentioned for many weeks, Kien, we as investors cannot be complacent in an environment heightened by macroeconomic risks. Rising interest rates, inflationary cost prices, all leading to slowing cash flows, contracting profit margin, and rising debt costs for companies. With the health of the market in decline also, it is no surprise to see a rise in the number of corporate insolvencies over the last financial year. And that's our core strength. That's our financial health model. That's the number one rule that we apply to identifying a quality company, and to see the number of companies now deteriorating in regard to their quality standard, then that is certainly a concern. But looking ahead, we believe this theme will also continue to play out as the full effect of rate hikes transition into our economy and into our company's financial accounts. Only last month, another two financially weak companies went into administration, Kien, and they were Optima Technology, or OPA is their ticker code. They were a software company for invoicing energy use and reporting, and Happy Valley Nutrition, or HVM is their code, an infant milk formula business.
Yeah, some very interesting companies with very good stories, Tim. But again, look at the financial health of these businesses. And the risk is not just prevalent among those small companies. Only this week, Tim, share register company Link Administration, a business in marginal financial health, they announced a 418 million loss. And that was driven by a messy exit from its disastrous acquisition of a UK business 6 years ago. And this, of course, is to the detriment of the shareholders, and currently about 78% of companies in the ASX are financially unhealthy. And with reporting season upon us, there is no better time to reassess the stocks in your portfolio after the release of the results. And with this in mind, Tim, what is your investment strategy, especially across the managed funds?
Yeah, it's been a big week for us in the managed fund business too, Kien, as I've been considering for many months now, what to do from a defensive position perspective, especially with all of what we've just articulated going on. So to manage a portfolio, and we're managing, around $750 million at the moment of client investments, what do we do tactically with all of the macroeconomic influences going on? So we've been holding around 30% cash now in all of our funds, both the Aussie and the US. And so what do we do with those funds? Do we even go even more defensive? And just on Friday, we actually flicked the switch on moving into that more defensive position. So our viewpoint is that the current earnings estimates for stocks appear too high in an economic environment where leading economic indicators suggest further weaknesses throughout FY24, hence why we flicked that switch. But markets, particularly in the US, have pushed higher over the last 6 months. That movement in prices has purely been a function of price to earnings expansion and not driven by fundamentals like earnings growth. So we've used this market rally to further reduce risks in our managed portfolios, hence why I've only acted now and not in the previous months. We've let the market run higher. Now it's time to act because we think it's a bit of a false environment. The instruments we've used involve selling future contracts, which in effect will significantly reduce the day-to-day volatility of our portfolios. To be clear, our unit holders and investors will continue to have exposure to our stock selection strategy, and if our stocks produce stronger than expected results during the upcoming reporting season, this will be reflected in the unit price. However, if markets push broadly higher or strongly higher, then we won't enjoy all of that upside because of that defensive position we hold in around 30% of our portfolio. But conversely, and more importantly, our unit holders have downside protection in the event that we experience a price correction. But this is not a forever position. We're not in this holding this position for the long term. When the economic picture becomes clearer, this will give us much more clarity on the corporate earnings landscape, and we will act accordingly in the management of our portfolios. So it is purely a tactical decision based on probability, and it has been made to protect the capital of our unit holders. And at this point in the cycle, when we believe the risks outnumber the rewards. So I hope that's all clear. We intend over the next few weeks to really explain that further to our investors and our Stock Doctor members too, hence why it's in Taking Stock today, so they could perhaps consider employing some of these same strategies in their own personal portfolios if they choose to do so. That is, adopt that more defensive position. But now let's turn our attention to some star stock highlights, Kien. Borderline star growth stock and rare earths miner Lynas reported its fourth quarter 23 production update, revealing revenue was below expectations despite strong production volumes. What was the reason for the revenue miss, Kien?
Yeah, interesting, Tim. The miss was caused by lower volumes of rare earths sold, as the company is accumulating stock in preparation for the ramp-up of its Kalgoorlie processing facility. Also, rare earth prices, they've dropped significantly since their peak in 2022, and that's mainly due to China, which is the #1 producer of rare earths. China announced a larger than expected production quota.
Despite these challenges, Kien, we can see that the 3-month earnings revisions for Lynas for financial year 23 is positive. What's driving this?
Well, some of you may recall our previous discussions about Lynas, its operating license in Malaysia, and the Malaysian government initially ordered Lynas to stop importing rare earth concentrates due to environmental concerns, and that was scheduled for July 2023. However, and what happened here is that the analysts forecast a significant disruption to their production, but the Malaysian government has now extended the company's license until January 2024, and that's resulted in substantial earnings upgrades.
Really interesting, Kien. And Lynas holds a highly strategic position in the rare earths market as the largest producer outside of China. With the share price being sold off and trading at a discount to valuation under Golden Rule 5, it could represent an opportunity for investors who are comfortable with the active risks associated with the mining of rare earth minerals. On another note, Kien, we had a financial update from star income stock BWP Trust this week. The REIT's real estate portfolio consists of large format industrial properties leased to Bunnings Warehouse and other specialty retailers. But the REIT has also been sold down on the back of rising interest rates, but is a forward dividend yield of 5.2% sustainable, Kien.
Yeah, BWP remains a safe pick in our view, Tim, given its lower debt levels and also strong balance sheet. So it really has that strong financial health relative to its peers. And rents are inflation linked and so should help them sustain dividends despite downward pressure on property valuations that's caused by rising interest rates. Importantly, Tim, management have guided that they will pay out similar dividends in financial year 24 as well. And taking a quick look at the corporate calendar for next week, there are an extensive number of companies reporting their financial results, but some notable names include ResMed. They released their quarterly today, not result, but they will release their results next week. And Commonwealth Bank and Computershare, please refer to our corporate calendar in Stock Doctor to stay abreast of all the updates.
And now to Under the Microscope, Kien. And this week, let's turn our attention to Credit Corp, a debt collection agency and unsecured credit provider that this week we proactively removed as both a borderline star growth stock and a star income stock. Credit Corp's been a great business since it was introduced as a star stock in 2010 at a price of $2.96. And now is trading close to $20. So investors and members, Stock Doctor members who have been in Credit Corp almost since the start have done obviously incredibly well. But we've got to be proactive with these removals when the fundamentals don't quite stack up. The company released its financial year 23 results on Tuesday, Kien, indicating a 5% decline in its financial year 23 net profit after tax figure, which was in line with both consensus and management's expectation. Despite delivering a stronger than expected second half, Credit Corp's share price reacted poorly, plummeting some 10% on the same day. So, Kien, the big question is, what caused the significant price reaction on the release of Credit Corp's results?
Yeah, I think what happened was that investors shifted their focus towards the company's outlook for financial year 24, Tim. Unfortunately, management's financial year 24 earnings guidance for net profit after tax of between 90 to 100 million was well below consensus expectations of around 105 million. Consequently, this led to the negative earnings revisions you're seeing on screen for Stock Doctor, especially for financial year 24 estimates.
Okay, thanks, Kien. It seems that the growth potential of Credit Corp's expanding US PDL division is narrowing as economic conditions tighten, which raises questions about whether the forecast double-digit earnings growth, as you can see under Golden Rule 3, is realistic.
Yeah, management's financial year 24 guidance also could be at risk of downgrades if conditions deteriorate further, Tim. If you look at the Australian and New Zealand PDL segment, that makes up about 43% of earnings. And there is limited supply as banks try to find a solution with at-risk customers personally. So banks are trying to fix the bad debt issues with their customers themselves, and that's causing low supply to come in. Also, you've got rising interest rates and inflationary pressures, and that's making it more difficult for customers to repay their debts, Tim.
And this is the reason you had to remove the stock from both the borderline star growth and star income stock classifications. And Kien, I suppose for those that want to stick around for the dividend, do you believe the dividend yield of some 5.3% is at risk?
Yeah, the dividend isn't overly high here, Tim, in the current environment, but we believe that gross dividend yield of about 5.3 isn't high enough to compensate investors for the risk, especially if economic conditions deteriorate further. Now, Credit Corp, it's a highly leveraged to the economic cycle. For example, Tim, while you have higher bad debt levels, they may increase the availability of PDL supply at quite attractive prices. Tim, it also weighs on Credit Corp's ability to recoup those debts. And moreover, Credit Corp's consumer loan business, it may face higher likelihood of bad debt write-downs as customers cannot pay back their debts, and so those payment cycles deteriorate.
Yeah, no point sticking around for a dividend, is it? If share prices could be vulnerable as well. So need to be very, very careful in these situations. But great guidance there, Kien, and thanks for the clarification. I also noticed that the short interest on the stock is currently around 5%, which is hitting that threshold that we don't like to see. So a few short sellers and the short register certainly increasing there. For those anticipating the second half dividend of around 70 cents per share, it is due to go ex-dividend on the 18th of September, about 40 days away. But again, with the increasing risk there, be careful staying with these types of business if there could be that further share price decline, and staying with them just for that dividend. And now to question of the week, Kien. And seeing reporting season is off and running, how can Stock Doctor members stay abreast of all the star stock changes that occurred during reporting season?
Yeah, quite a timely question, Tim. The most important place for the latest star stock updates is on the research homepage, Tim. And to get more detail, just click on the View All, and this will take you to the recent updates and announcements page. You can also access this page under the Tools header and by clicking on recent updates there too. So here, you'll be able to monitor the star stock recommendation changes by selecting all companies, choose a time frame, say 3 months, and then select star stock recommendation changes. And the tool will then provide you with a list of all star stock changes over the last 3 months.
Excellent, Kien. Yeah, the recent update feature, it's a beauty. Just spend a bit of time there and study it to get the most out of it. But it is a terrific tool during reporting season, especially if you're not able to be in front of your computer every single day. But you can also set notifications for any star stock changes using the alert manager, and by selecting the star stock change alert and ensuring that you have the analyst comment notification also activated. That way you're going to always stay abreast of any of those changes. And once you've done this, make sure you fully read the analyst commentary and strategic commentary to understand why a stock has been included or excluded from our star stock universe, just like we saw with Credit Corp this week. That will enable you to make a really confident and informed decision relative to the inclusions and exclusions from your portfolios. All right, Kien. Well, another taking stock comes and goes, and it's obviously on the cusp of a really, really important time of year, and at a time when we've got so much economic uncertainty going on at the moment. So thanks for sitting down and sharing your insights, Kien.
A pleasure, Tim. And it'll be interesting to see how many businesses fail their financial health this reporting season. So our analysts will be on top of it. But if you have any questions, feel free to come in. Even though we're very busy, we're always there for you.
Yeah, look, great point, Kien. And the golden rule 1, financial health, has never been more important than right now, especially in this rising interest rate environment. So just to summarize on today, volatility in the markets, it's very normal. It's a normal thing for this asset class, which is the share market. Make sure you have proper risk management techniques in place to help you navigate the volatility, though. We can't be complacent. We've got to navigate the volatility, but it is very, very normal. Focus again on financial health. Even large companies like Link Group are not immune if they haven't quite got their act together. And take advantage of Stock Doctor by keeping abreast of all the star stock changes over this reporting season. Any questions on anything we've been through today, make sure you give our analyst team, Kien and his team, a call, or even your relationship managers there to also guide you through this environment. Okay, great sitting down with you again, Kien. Stay well, everybody. Have a happy, healthy, and prosperous week.